Welcome back to the Privatized Banking Project. Is real estate really the golden ticket to financial freedom, or is it an overrated, overhyped gamble? Today, we're breaking down the real pros and cons of real estate investing, with no fluff and no sales pitch. Whether you're considering your first rental property or just trying to diversify your portfolio, this video will help you make smarter, more grounded decisions. First, let's talk about what makes real estate so appealing. One of the biggest advantages is tangible ownership. Unlike stocks or crypto, real estate is a physical asset. It provides shelter, utility, and often a recurring stream of income. You can see it, touch it, and importantly, leverage it. That brings us to another major benefit: access to debt. Real estate is one of the few assets banks are eager to lend against. With as little as 20% down, you can control 100% of property and let tenants pay off your mortgage while the asset hopefully appreciates over time. Second, real estate offers strong tax advantages. Between depreciation, mortgage interest deductions, and 1031 exchanges, the U.S. tax code is extremely favorable to property owners. For investors with high earned income, these deductions can offset significant tax liabilities, especially when structured properly. Another powerful reason investors love real estate: cash flow. When done right, rental properties can generate consistent monthly income. That's income that often rises with inflation, while your mortgage stays fixed. That creates a widening spread over time, and it's one of the most popular ways investors build passive income that doesn't rely on trading time for money. But now, let's talk about the downsides, because they're real and they matter. First, liquidity. Real estate is not a quick exit game. If you need to cash out fast, selling a property takes time. And depending on the market cycle, you may not get the price you want or need. The lack of flexibility can be a major issue if you face an emergency or shifting in the investment strategy. Second, the hidden costs add up fast. Maintenance, property taxes, insurance, vacancies, management fees, legal issues, capital expenditures, all of these can quietly eat into your returns. Many new investors underestimate these costs and overestimate their cash flow. Real estate isn't truly passive, especially if you're self-managing or dealing with tenant turnover. Another serious concern: market risk and local volatility. Real estate is hyper-local. One zip code over can mean the difference between steady appreciation and years of stagnant prices. And while real estate values tend to rise over the long term, they're not immune to downturns. Just ask anyone who owned property in 2008, or even in the overheated markets in 2022. Timing, location, and strategy are everything. Finally, leverage is a double-edged sword. Yes, it can magnify gains, but it can also magnify losses. If rents drop, tenants stop paying, or rates spike, that same debt that once worked in your favor can quickly become a liability. So, is real estate investing worth it? That depends entirely on your goals, your risk tolerance, and your ability to manage complexity. It can be a powerful pillar of long-term wealth, but it's not a one-size-fits-all solution. And it's definitely not passive without planning, systems, and discipline. If you found this breakdown helpful, subscribe to the Privatized Banking Project for more clear, non-biased financial education that puts you in control of your money. Like this video, drop a comment with your real estate questions or experiences, and remember, financial freedom isn't built on hype. It's built on understanding. Stay sharp, stay skeptical, and keep building.